Hey everyone, an offering that comes after an IPO is called a secondary offering. Let's take a look at what that means. An IPO, or initial public offering, is when a private company first sells shares of stock to the public. Once a company goes public through an IPO, it can, but is not obligated to, sell additional shares of stock from time to time. When a public company sells additional shares of its stock, that is called a secondary offering. The money raised from the sale of those shares goes to the company, not to the original shareholders. But the original shareholders may choose to sell some of their shares in the offering. Here's an example to help you understand this concept. In 2016, a company went public with an IPO. It sold 1 million shares of stock at $10 per share, raising $10 million. 2 years later, the company decided to raise additional money by selling 500,000 more shares of stock. The company didn't need that money, but it was an opportunity to raise $5 million with little effort. That's because it was a secondary offering. The money from the sale of the stock went to the company, not to the original shareholders. However, some of the original shareholders chose to sell some of their shares in the secondary offering. So the number of shares owned by those shareholders went down, but the company didn't have any control over that. They only know how many new shares they were able to sell. Now, if you're an investor who bought stock in either of these offerings, you would be a shareholder, but you'd have no way of knowing which shares you owned. If you bought shares in the secondary offering, you'd have no way of knowing whether you bought new shares or shares that were sold by original shareholders. Companies typically use the money raised from secondary offerings to fund things like research and development, capital expenditures, or acquisitions. But in this example, the company didn't really need the money, so instead they just held on to the cash for future opportunities. It's important to note that secondary offerings are not the same as an equity offering. Equity offerings include things like employee stock plans and restricted stock units. Those offerings don't typically involve selling shares to the public. Hopefully this clears up the confusion between secondary offerings and IPOs. Thanks for watching.